The Fed15 podcast is presented by Serving Those Who Serve, a financial planning practice serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of either Raymond James or Serving Those Who Serve. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc.
Welcome, everyone, to the Fed15 podcast, presented by Serving Those Who Serve. Each week, we discuss the latest news and info that Feds need to know in 15 minutes-ish or less. So whether you are a seasoned federal employee, just starting out in your career, we've got you covered. So grab your coffee, your energy drink, your green juice, whatever gets you going, keeps you going, and we'll tell you what you need to know but might have missed. We are your hosts, Dan Sipe, and I am joined by the incomparable, irreplaceable Katelyn Murray. And how do we know she's irreplaceable? Because she's back.
Hi, everybody. It's been a while.
Been a minute.
Yeah.
So, how was Amsterdam?
It was fantastic. It was lovely. It was much cooler than here, but this will be known for me, I think, as the year of two springs, because they're just far enough behind us that I got to watch all of the trees sort of burst into bloom and all of the new growth here. And then I got on a plane and went over there, and it was just the perfect week of everything was just kind of all of their trees were just budding out and opening up their new leaves for the year. And that was really fun. That's always a special time. So it was very cool to get that twice this year.
Nice.
But yeah, lots of cheese. If you're a big cheese lover, obviously, wonderful place in the world to go. Got to learn all about Gouda and go to the Gouda cheese market, which if you're a cultureless American like me, that would be Gouda. But yeah, it was wonderful. Wonderful, wonderful time.
Well, Jen did great, but we still missed you, and it's great to have you back.
Awesome. Good to know. I've still got my gig here.
Oh, no. If there's anybody that's going to be replaced, it's me. I was sitting there going, man, if the folks ever figure out they can have Jen and Katelyn, I'm out. I'm up on the top shelf with the Woody, if that happens. So we've got some really interesting stuff this week. I'm going to be talking about FEGLI, which people don't talk about a lot. I've actually been talking about it for about 40 years now. And then Katelyn has a super topic, which is two pensions, one plan, taxes, timing, and survivor choices. So that's definitely going to be some juicy stuff. So if it's okay, I'll just kind of jump in on the FEGLI side of the house. I think everybody in federal service knows and understands that they have access to the Federal Employee Group Life Insurance Program. But after that, the level of understanding starts to drop pretty quickly. So there are two components, basic and optional coverages. And they're really kind of almost different species. They are both group term, but their cost structure behaves very differently. And we're going to be talking in this article specifically about FEGLI Option B. But the FEGLI Basic is a flat cost over the course of your career. And it does have the ability to keep portions of it in retirement, potentially at no cost. So that's an important distinction. One of the things that we have seen is that people are often surprised at the cost increases that go along with Option B. And with Option B, you can, for those of you, for whatever reason, don't know, you can elect up to 5 multiples of your salary during an open season or when you are originally hired. However, there is no subsidy for it. Your basic is subsidized substantially by Uncle. The optional is not, and you carry the full cost. Why is that a thing? Well, when life insurance becomes an employee benefit, it must of necessity be non-discriminatory. So it can't discriminate between smokers and non-smokers, people in average health and people in poor health. So what they must do is average all those costs together into one proto rate, and that includes men and women. Well, The reality is, in the private sector, women pay less for life insurance than men do. Non-smokers pay less than smokers. People in good health pay less than people in poor health. Well, when you have all that averaged together, what that can mean is the non-smoker in at least average health, their rates have been averaged away from what the costs might be in the private sector. So when you're making these decisions, you're going to, if you pay attention, you will see cost jumps. If you don't pay attention, you will see it at 55. Okay. Pretty well guaranteed that cost jump will happen. The most celebrated example I ever heard was I'd been consulting with somebody for a bit, telling them it was coming, and they kind of brushed me off. And then I got a frantic call in the new year where they said, "You told me my insurance was going to go up, right?" I said, "Yes, I did." He goes, "It wiped out my COLA." So it could be a pretty significant jump. So as you hit these milestone ages like 55, question number one, is it still doing for you what it was when you first set it up? Do you have the same risks out there? Do you still have kids at home? So number one is reassess what your needs would be at this time. Then you may want to have a conversation about the difference between the group plan and private coverage. What private coverage has the ability to do is take your individual health and risk profile into the cost. And yes, that can reduce your out-of-pocket expense, again, because remember, in the group plan, everybody's averaged together. And this is not a bash on FEGLI. This happens with all group plans. And, how can you easily compare that? Look at your deductions on your leave and earnings statement for your optional FEGLI. Multiply that out times 26. Be aware of what the total death benefit will be because it's your salary rather than the next highest 1,000. And then multiply that times 1 through 5. And then request a private term quote. A couple of things you'll want to understand is that one of the things that happens with your FEGLI coverage is it will go up automatically with your salary as your salary increases. That could be good, that could be bad. So if you are getting a private plan, that will be a static death benefit. So you may want to hedge a little higher on the amount if you're going to replace that. Now, the one thing, and if you take nothing away from this, don't forget this one. You do not change horses in the middle of the stream until you know the size, color, and temperament of the horse that you're going to. So you are going to be going through individual underwriting for that private term plan. Do not drop your FEGLI as soon as you apply. Don't do that. Don't. I run into people every year that have done that. Wait until the whole underwriting is done, your new policy is in place, and then put through the change. Will you have some overlap? Yes. Any other way, you are taking too big a risk, because I've seen too many situations where in the 11th hour, that policy doesn't come through or doesn't come through in as good a cost structure, and then you're stuck. So sorry about that little over-the-top rant with that. But the one thing I'm going to do throughout the rest of my life and career with you folks is keep you from smashing into the walls. Now, the other thing, if you're looking at changing option B, don't drop everything because again, and we have great articles on this, you can continue FEGLI Basic in retirement with a 75% reduction for free as long as you've had it for 5 years. Okay, and you pay for it up until 65. So you don't want to just drop everything because that's another heartbreaker that I find. We'll meet people and they'll say, yeah, I talked to the folks online and they said it gets expensive, so I dropped everything. Well, did you know that you could get basic for free in retirement? I didn't know that. So that's the second thing to take away from this. If you're making these changes, don't drop basic. Just don't do it. That's it. That's what I got, Katelyn. Now, tell us about planning.
Absolutely. When you said you wanted to cover the FEGLI topic, I knew we were going to get some hot takes.
I just don't want people getting hurt.
Dan started out in insurance, folks, so he's very passionate about FEGLI and about making sure that people have the appropriate coverage, not overpaying for coverage that they don't need, but then also not giving up coverage that is beneficial. I mean, I've crunched the numbers for lots of clients, and I'm certainly not saying this is the case for everybody, but, taking that 75% reduction and getting that 25% remainder basic FEGLI coverage that is for free, right? There's no premiums that are due once you turn 65. Even if you're retiring at 62, or God forbid, don't let Dan hear you, 60, if you crunch the numbers on your premiums that you are going to pay for that basic coverage from 60 to 65, if you figure out what it is from every paycheck and you figure out what 5 years of that is, that pales in comparison often to the coverage that you are getting moving forward for your family in perpetuity. So definitely measure twice, cut once there.
Katelyn, that was not fair bringing up age 60 when I was already in rant mode.
You better get that 1.1 times pension multiplier. All right. So kind of scaling back just a little bit and taking a little bit of a wider focus, right? One thing that we try to keep a good balance here at Serving Those Who Serve is we like to kind of do the deep dive on the topics and kind of examine each of the benefits kind of in detail, but we also like to kind of always keep in mind that comprehensive financial planning, that comprehensive picture. And this article from the blog this week is a really good example of that. This article is called Two Pensions, One Plan, Taxes, Timing, and Survivor Choices. So really what we're looking at here is overall cash flow and how you can manage that with respect to taxes and also some of your survivor benefit choices. So the first thing that you're going to want to do if you're trying to get a handle on your cash flows in retirement is you want to list all of your predictable retirement income sources, okay? So this is going to be your federal pension. For most of you guys listening to this, it's your FERS pension. But my CSRS folks, we know you, we love you. CSRS pension would be included in that as well. Any state and local pensions that you may have. It is very common for folks who've worked in the federal government to retire from the federal government and then go to work for the state or local government, and that could come with a pension as well. Any private pensions that you have, they are rare, but I do come across them from time to time, particularly folks who've worked in the trades for a while. They'll have electricians' pensions or things like that. You want to make sure that you're noting that as well. Even if those are smaller pensions, you want to make sure that you're factoring them in, particularly with regard to taxes. Social Security is a form of income stream, and you want to make sure that you're kind of including an estimate, basically. You can get a really good estimate by going to ssa.gov and pulling a Social Security statement. And then any planned TSP or 401k withdrawals. That factor is going to be the factor that you have the most control over because you can adjust that one, right? I can decide to take $500 out of my TSP this month instead of $5,000 out of my TSP this month. And that's totally up to me, right? So once you kind of have all of those listed out, you want to then categorize your planned expenses. So what are your essential expenses? This would be stuff like housing, insurance. Yes, you still need to pay for insurance in retirement. People can sue you in retirement. Get your umbrella coverage. If you don't know what umbrella insurance is, go to STWServe.com. Search umbrella and you will learn. Utilities. You got to have heat. You got to have air conditioning. For most of us, we live somewhere where air conditioning is kind of an essential. Groceries. That's my favorite one because I get really hangry when there's not enough groceries. So I got to make sure that's essential for me. And then other monthly bills that have to get paid. This is my, catch-all category for if I don't pay it, they're going to take it from me or take me and put me in prison. Right? The other category is your flexible expenses. Now, this is stuff over which we have a higher degree of control. This is stuff like travel, gifts, hobbies, larger purchases. If you want to retire and you're a golfer and you want your membership to the golf club, right? That's a pretty penny for a lot of these golf clubs. You want to make sure that you are planning for that. But it is also in the flexible category. Don't know that I would put that under essential. I would say the number one thing that I see most people doing as a financial planner is they underrate that flexible income. But here's the thing, because it is by nature adjustable. Here's the thing, you worked your whole life to have this retirement. This is the only time that you're going to get to have this retirement, right? Enjoy it. You're not going to work for 40 hours a week, or for many of our feds, more than 40 hours a week, because you guys put your time in. you have more time to do the things that you enjoy. And this is the only chance you're going to get to do them. So even though it's a flexible income structure, plan to have the excess income to do the things that you want to do, because I want you to do those things. So once we've got our list of all our income, and then we have our list of our flexible and our essential expenses, then we can start looking at how much of our expenses are going to be covered by those pensions. Because as feds, with the exception of any private pensions that you have through any kind of trade unions or things like that, your pension is backed by the full faith and credit of the U.S. government. Social Security, also backed by the full faith and credit of the U.S. government. So that is what we would call a fixed income stream. And it's relatively guaranteed. What is it guaranteed by? The full faith and credit of the U.S. government. So that is kind of income that we can count on, as opposed to your TSP, your 401k, IRAs, Roth IRAs, brokerage accounts, because those things are invested in the market. And even though it's important to have that portion of income, it is variable, right? So your pension, your first pension is going to be your fixed income. Your Social Security also counts as fixed income. Any TSP or investment portfolio withdrawals are going to be variable income because you can adjust that, okay? So once we have that kind of high level review, then we want to dig into how much of the pension is going to cover this bottom line number between the essentials and the flexibles. And that's how we figure out how much we need to pull from the investment portfolio. And based on how much we need from the investment portfolio, that's how we figure out, am I saving enough? Am I invested appropriately? Okay. We won't get into that here, but you can find lots of good information on figuring out how to invest your TSP and that sort of thing on our website at stwserve.com. Okay. Survivor elections, because at the end of the day, it's a reality. None of us are going to make it forever except for Dan. We've made a deal with the powers that be. We're going to keep him forever. But the rest of us, poor mortals, do have to face the reality that at some point we will leave this mortal coil behind. And if you are married, survivor elections become really, really important in that situation, because we have planned out this income and we have our lovely fixed income piece. If I'm the Fed in the relationship and I die, that pension income can go away entirely.
Sure.
Right? Unless I have made certain decisions to protect those that I'm leaving behind. So what are those decisions, right? You have survivor elections that you can take. On your federal pension, you have choices. You can leave no survivor benefit. You can leave a 50% survivor benefit. You can leave a 25% survivor benefit. And those are basically, in general, your three options. And if you select that either one of those survivor elections, your surviving spouse can continue to get paid after your death, and vice versa if you are not the Fed and listening to this. So often we have double Fed couples where we've got two pensions. We've got two first pensions that are happening, or we've got a federal pension and we've got a state pension. We want to make sure that we're comparing both survivor structures and making sure that we're making the right choices there. Some people will say it's an automatic given that you just do maximum survivor benefit for both pensions. I will say not necessarily in every single case, okay? If you're not sure and there's no information that exists out there on survivor benefits and how to make these decisions, then sure, better to go with it than not go with it. But that's not the case, because Serving Those Who Serve exists. And we have a whole survivor benefits webinar that you guys can hit. It's one of our on-demand webinars, and you can find that on our YouTube channel, actually. So you want to make sure that you're doing some amount of evaluation so that you're maximizing your pension benefit, because you really shouldn't pay for a survivor benefit that you don't need to carry. All right. In general, too little coverage is going to create a sharp income loss for your surviving spouse. You don't want that. But too much coverage can reduce your current income without really adding meaningful security. Okay. And meaningful security is going to be a different definition for everybody. If you're curious about that, again, the Survivor Benefits on-demand webinar, definitely check that out. You can also reach out to us at meetings@stwserve.com, and we can do a custom benefits evaluation for you and give you a little bit more detailed, nuanced advice for your specific case. Now, the tax piece here, I want to make sure that we address this. Most pensions are going to create taxable income. Very rare that they don't. VA disability is a good example of one that actually doesn't. You're not taxed on that income. But your first pension certainly is going to create taxable income for you, as will your CSRS pension. And especially when we've got multiple pensions in the pot and we've got Social Security and we've got portfolio withdrawals, that can quickly change your tax picture. Not to mention, we've got RMDs that start for most people between 73 and 75. And, that is forced money that you're having to take out of your pre-tax retirement accounts, okay, and be taxed on. So you want to make sure that when you're looking at pension planning, you are factoring in, where am I going to be in the current tax structure and where could I be in the future tax structure if things change with taxes, because taxes are more than likely going to change within your retirement timeframe. Okay. You want to make sure in general that you are watching for years in which your taxes are spiked. Examples for you. The first year of retirement, let's say you retire December 31st and your leave gets paid out and you also get your pension. That could be a higher year of income for you, which is going to boost you in the tax structure. Let's say there's a year where something happens and you end up having to take a bunch of money out of your TSP or out of another pre-tax retirement account. That can boost your income. And then also Roth conversions, a favored topic here at Serving Those Who Serve. We love them, but they do result in higher taxable income. Now, there are ways to offset that. That's not what this episode is about, but there are ways to offset that higher income. And you may consider pairing one of those strategies, like a donor advised fund or other charitable giving techniques. Okay. For more information on that, you can hit our website. But you want to make sure that you're planning ahead and you know when those spike years are going to be. The year that your R&D starts is possibly another one, unless you're already pulling out of your portfolio at that time. If you plan ahead, you can kind of smooth that income out across the years and reduce surprises. So we also want to give some thought to timing around who's claiming what and when. Pensions, typically going to be payable as long as you're eligible to retire. When you retire, typically going to be payable as soon as you retire. Okay. Social Security, a little bit more flexible, a little bit more nuanced. I can retire 8 years before I collect Social Security. If I retire at 62 and I don't collect my Social Security until 70. In general, if both of you guys qualify for Social Security, if both spouses qualify for Social Security, the higher earner claiming age is what's going to matter more in general. And also in general, when one spouse dies, the surviving spouse typically keeps the larger Social Security benefit. Okay. So if my benefit's higher and my husband passes away, I just stick with my same benefit. If his was higher, they switch me over to his. Technically, they take mine and the difference of his and they credit me the difference. But the impact is I'm getting what he was getting. But that's still, you'll notice, rather than getting mine and his, now I'm just getting whichever one was the higher benefit. So that's going to potentially create an additional income need for me on which I would lean on my portfolio to cover if I needed to. Okay. And then lastly here, looking at withholding and cash flow tuning, this is why the investment portion of your portfolio is so important. So we talk about federal retirement being a three-legged stool. Your pension is one leg, Social Security is one leg, the portfolio, the investment portfolio, including TSP, other retirement accounts, and brokerage accounts, that's your third leg. And that is that leg that we talked about earlier that is flexible. So when one spouse passes away, if additional income is needed to make up for the Social Security benefit that's being lost, you can increase distributions from the portfolio. As you get older, and some of those expenses that we talked about, those essential expenses, healthcare is one of them. As you get older, that healthcare expense is going to increase, and that's going to be you leaning on your portfolio in most cases. By the way, all of those expenses, fixed and non-fixed, over time are going to increase due to inflation.
Sure.
Okay. So that's why the investment piece is so important, because that is your flexible portion that you can use to supplement these pensions and, have a good quality of life in retirement. So if you are thinking, all of this sounds really good, Katelyn, really appreciate this high level overview, but where do I get started? I've got a checklist for you. So first thing you want to do is confirm your survivor election on each of the pensions in your household and understand the survivor income impact of, what you're thinking you're going to do, whether that's 25% benefit, 50% survivor benefit, what have you. I will tell you, just word to the wise, the maximum survivor benefit for FERS is 50%. For that, you pay 10%. Even if you have a $4,500 a month FERS pension, you're going to pay $450 a month to have that survivor benefit. And that's going to guarantee your spouse $27,000 adjusted by inflation each year if something happens to you. It's pretty cheap as far as insurance goes, right? It's pretty darn cheap. You're not going to find a whole lot elsewhere that's going to be cheaper than that. So especially one that's going to continue into your 70s, 80s, and 90s. So just a word to the wise on that. Next thing we're going to do on our checklist is we're going to review taxes under 3 different scenarios. The period where both spouses are alive. We're hoping that's the longest period. Long, happy, healthy. The period with one surviving spouse. And I want you to double check that first retirement year with the annual leave. It will make a big difference in a lot of cases. Last thing I want you to do, I've told you to do before, check your beneficiary designations on retirement accounts, but also all of your accounts. While you're in there, check it for everything, even your bank accounts. And then lastly, you want to make sure that you confirm that those designations align with your broader household plan, okay? 2 pensions can give you a really strong retirement foundation, but it's really important that you think through survivor elections, Social Security timing, tax withholding, all of these different items in order to make the most of it, okay? And coordination is going to maximize your long-term household income. And again, you guys know I'm not about making money just for making money. I'm about making money so that it can be translated into meaningful experiences for you, because this is your one beautiful life. And I want you to live it to the fullest. Okay. So that's that on that. For more information, if you need to dig into any of that a little bit deeper, I know it was a lot of info that we covered very quickly. Hit the blog at STWServe.com and you'll find that article there. It's 2 pensions, 1 plan. So with that said, I think it's a little bit past time to wrap up. But listen, it was my first episode back. I had to spend a little extra time with you because I just missed you so much.
You did great. And I'm listening to this and I'm going, there's only one Katelyn. There is only one Katelyn.
You know I love to yap. I love a good yap session. But we will be back next week with another great yap session to bring you all of the latest updates that you need to make informed decisions about your career and financial well-being as a Fed and live your one beautiful life to the fullest.
Absolutely. And be sure to subscribe to these Yap sessions on YouTube and Spotify so you never miss an episode. And please, please, please remember to share it with your friends and colleagues. The subscription is really important, folks, because it helps us amplify. The algos will say, yay, lots of Feds are looking at this. We'll show it to more Feds. So please, please, please do that and share it again with friends and colleagues.
For sure. I've told you once, but I'll tell you again. For more information on the topics covered in today's show and more, be sure to check out our blog at STWServe.com. We've got a lot of great content there written by our team, certified financial planners, guys. So we know what we're talking about. We talk to Feds all day, every day. We also have articles in the Fed Zone written by the one, the only Mr. Ed Zerndorfer, the federal benefits guru himself. There's a lot of totally complimentary information there that you can access at any time, day or night. While you're on our website, make sure that you subscribe to our newsletter, the weekly serving, and that way we will round up all of the latest news for Feds and send it straight to your inbox every week.
And don't forget those live webinars that we are kicking out. We do several every month. A couple of the ones coming up that you don't want to miss. We have got our ever popular TSP webinar. Katelyn and I will be tag teaming on that. That's May the 20th from 11 until 2. And then on June 2nd, we've got our financial planning webinar that folks just love. That will be skippered by Katelyn, and I'll be second chairing that. That'll be June 2nd from 11 till 2. You don't want to miss it. And if you are looking for something a little more personalized, you can hit us up at meetings@stwserve.com and avail yourself of one of our part 2s. What is part 2? Part 2 is where you get your personal questions answered on anything that you ever read, watched, observed, you name it. If you've got follow-up questions on it, we can handle those questions for you. We're happy to do it. So by all means, avail yourself of that opportunity.
Absolutely. All right, everybody. Thank you for listening to the Fed15. I'm Katelyn Murray.
And I'm Dan Sight.
And we'll see you next week.
Yapping away.